This week, Donald Trump reignited his trade war, slapping 145% tariffs on Chinese imports like it's a clearance sale at Smith & Co. Westpac chief economist Kelly Eckhold returns to decipher this diplomatic demolition derby.
Financial freedom faster. Financial freedom faster.
Last week, more people watched this channel than all other New Zealand property shows combined. Subscribe and get ahead. We are your unfair advantage in New Zealand property, served daily, no apologies. Kelly Eckhold, give it to us straight. We have an export-heavy economy, fragile growth, and a property market already walking with a limp. How bad is this for New Zealand?
Well, I think it's fair to say that it's a pretty threatening situation, particularly for the export sector, given what's going on in these global markets and the changes in the rules of the game of the global trade system. We haven't really seen changes like this happen really since about the 1930s, I suppose. So there's plenty of risk there. I think I've talked before about the fact that New Zealand is a trading nation. Quite a substantial amount of our national income comes from selling exports. So the potential for downside risk in terms of the growth rates of our export partners matters quite a lot. What also matters quite a lot is the extent to which our trading partners fight with each other as well, because that will just make it worse.
And is it something where we can lean on Australia for a bit of help, or have they got it worse than us?
You know, we wrote a note recently just comparing how New Zealand and Australia would go in this. The overall view is that we've both got the same sorts of underlying vulnerabilities to reduce trade, but New Zealand or Australia could do better at this depending on how things pan out. And I think one of the key differences is really around how China performs compared to the United States, which is quite convenient when you consider that they're the center of the big fight that's going on now with respect to tariffs. Australia's big strength over the last 10 or 15 years has been that they've been big exporters of industrial supplies that go into the steel making industries, for example, in China. Our strength is that we export food and agricultural commodities. What that means is that China, if it does well in being able to maintain the strength of its exports in terms of manufactured goods, well, then Australia will do relatively well. But New Zealand will do really reasonably well if globally manufacturing sector is weaker, but demand for agricultural commodities and food in particular holds up. I think a line that I kind of put in our note, which I thought was interesting, is that, you know, if we end up with a really weak global economy here, people are still going to eat, but they may or may not want to buy more steel.
Well, it seems like even from the highest highs, the likes of Nick Mowbray, down to just people buying coffees on the street, the velocity of money has really slowed down. People are not making decisions about production long term, but also keeping money in their wallet. How do you track how this is impacting things?
What we have to do is we have to have a look at some of the highest frequency indicators of what's going on in the economy. So we get monthly reads, for example, on things like consumer and business confidence. We get some weekly reads in terms of what's going on with the job market, which is really valuable right now. But I'll say, Andrew, that the biggest thing I'm trying to do is reach out to our customers who are right at the coalface of some of these sort of issues. So we've got a whole lot of customers in the export and import industries that operate in China and the United States. And I'm trying to maintain a pretty close dialogue with them to try to understand how much this is going to matter and when it might matter.
A reminder, money's not polite. It moves fast, and the people subscribed to this channel, they're already running past you. Thinking about it won't save you. Subscribing might. China's response, especially to its major partners, Australia being one. I saw Australia exports commodities, 2 or 3 products that they export to China is bigger than New Zealand's total exports. Are we looking at a situation where China could start importing from their alliance countries instead of the US and Australia and really change how the world works?
There's quite a good chance that something like that is likely to happen. Even if all of the fighting started to die down tomorrow, the memories of what has happened in the last 6 weeks are going to be sitting in people's minds for quite a long time. I'm conscious, for example, that a week or two ago, the Prime Minister of Canada, Mark Carney, made quite a bold statement where he said that the special relationship between Canada and the United States is over. So that means that, people out there are looking for different options to be able to make their supply chains more resilient. And, one of those things could be, for example, that in the Chinese case, given that perhaps their trust level with the United States is a bit lower right now, they may look to secure some products, perhaps from us or from Australia, that previously they might have gotten from the United States.
Yeah, so some of the negative effects being felt around the world and certainly by some of our allies could actually end up playing well to a country like New Zealand that is quite willing to sit on the fence in terms of not choosing sides. What impact is the current situation having on the exchange rates, the New Zealand dollar versus US and versus the Aussie dollar?
So there's been enormous variability. The New Zealand dollar against the US dollar has traded in a really wide range in the last 7 days. It touched as low as just below 55 cents back on the middle of last week when those big reciprocal tariffs and the retaliations were being announced. But then subsequently, as some of those measures have been wound back or delayed, we've actually seen a bit of optimism return to those markets. And we've seen the New Zealand dollar go up now, and I think it's over 58.5 cents today. So that's quite a lot of variability. I would say, though, that we should expect a lot more of that sort of volatility as we go through the next few months.
RBNZ, OCR updates. Now, I've seen BNZ, for example, they've been saying 2.75 for a while, even before this happened. You're still sticking with 3.25 as where you think we're going to end up. Why are you not updating your forecast based on what's going on right now?
Because things haven't settled down, we're basically in a situation where the direct costs of this downturn for New Zealand are actually not that large. I mean, a 10% tariff on New Zealand is worth perhaps 0.2% of GDP, $900 billion a year. $900 million a year. It's not necessarily the end of the world when you consider that export prices here have risen quite considerably, perhaps in the order of kind of like 15 to 20 percentage points, depending on what you're looking at over the year. So if things settle down, it might well be that perhaps we've got a bit of downside risk to our interest rate forecasts, but maybe not quite as much as some of the knee-jerk reactions I saw from financial markets, perhaps some of the other commentators on the street. My preference is to sit back and do a careful, calm assessment of what is actually likely to happen rather than jumping at shadows right now.
Yeah. You can explain that as don't panic, but you can also say don't panic. Like, of course, there's going to be different kinds of responses. So OCR, we can all agree, is still going down. I've seen interest rates 4.99 from a few different banks being advertised, and actually even lower than that in some of the private pricing channels. Does this keep pushing house prices up?
I think that right now we've still got a fairly firm, gentle uptrend in house prices in place. We actually saw some of that data just today, actually, where we saw another rise in the monthly house price index. Also, interestingly, including an increase in Auckland house prices, which hadn't really been moving so much so far. There's no upward pressure on mortgage rates right now. So, in fact, I think some of the banks have even reduced their shorter-term mortgage rates such that they're all sitting at the 4.99% level right now. I would have thought that with this movement in wholesale rates that we've seen occur in the last week or so, once things settle down, there's probably a decent chance that we get another leg down in fixed mortgage rates, perhaps another 20, 25 points off. That's got to be good for housing investors, people looking to be first home buyers. It's going to improve affordability. We've seen a steady increase in credit demand take hold in the last 6 months or so. We're not talking about a boom here, but it's certainly very supportive.
Great time to buy. House prices look like they're going to be going up sometime soon. So appreciate your insights today, Kelly. And I do suggest people take a look at your recent economic report release and follow you along on LinkedIn. Pleasure talking to you again, Kelly, and we'll talk again soon.
Good as gold. Don't panic.
Don't panic!